Right. So we are looking at financial reporting. With financial reporting, it is the advanced form of the financial accounting paper, which is seen in the level 1 of our professional curriculum. And after going through financial reporting, the next paper which relates to accounting, real accounting, is in the area of strategic business reporting. Strategic business reporting, right? So the first standard we are looking at will be in relation to inventories. I've hinted that nobody can pass this paper without having a good grasp of accounting standards. Then after going through the accounting standards, you are supposed to also know your template. You have to know your template. A good grasp of accounting standards will help you pass the financial reporting paper. So every standard is having 3 main elements. The first side of an accounting standard is the recognition side of the standard. Then we have the second side to be the measurement side of the accounting standard. And the final side of every standard is the accounting treatment. When you talk about accounting treatment, we are talking about debits and credits, right? So we are saying that every accounting standard is having 3 main elements. So I will just pick them one after the other, then explain. The first one is what? Recognition. That is when we decide to give that sense of belongingness of the standard to its what? Family in terms of that. And in instance of, let's say, expenses, if you turn out to have or maybe come out with issues of, let's say, office expense, you know for sure that in fact it's an expense. If you incur, let's say, a telephone expenditure, it is what? Expense. And we know for sure that all expenses are having what? Debit balances. If we purchase an asset, we know for sure that this asset is supposed to be added to PPE. By adding such an asset to PPE, we are trying to give it the sense of belongingness. We are trying to give it recognition. So when we talk about an accounting standard having recognition, we are saying that try to give it that sort of sense of belongingness, right? Aside the recognition aspect of every standard, we also have measurement aspect of a standard. And with the measurement of aspect of a standard, we are looking at quantification, how we can give valuation or value aspect of what of the standard. In the case of IAS2, I'll show you which side is giving the recognition, which side is giving the measurement, and which side is giving the accounting treatment. So measurement will give you the valuation, the value. Here, that is where we are going to determine the quantification pertaining to the transaction in relation to the accounting standard. And the last aspect is accounting treatment. Accounting treatment, this is when we think of passing a debit and credit entry. That is looking at debit and credit, because with issues given by Luca Pacioli, he's saying that with the golden rule of accounting, there's going to be what? A transaction having a debit entry, and that transaction should also have a corresponding credit entry. So after making a posting of all adjustments, or at least an accounting entries, at least the net effect should be 0. That means that you should have a debit with a value and having a corresponding what? Credit what? Entry. Good. For us to really be on point as accountants, we are to know transactions which are having debit balances and the golden rule of accounting treatment. So let's look at some transactions which are having debit balances. So items that has debit balance. We can talk about, first of all, assets. Assets here, we are talking about both current and PPE. So we are saying that current asset is an asset and it's having a debit balance. Non-current asset in the form of property, plant, equipment is an asset also having a debit balance. Then we come to issues of, that is the second thing, expenses. Expenses also have what? Debit balance. We can talk about losses. Losses are having debit balance. Then we can also talk about issues of probably We can talk about, we've talked about expenses, we've talked about losses. I think this categorization will end for all other elements. So assets having debit balance, expenses having debit balance, losses having what? Debit balance. Then let's look at some elements which are having credit entry. So let's look at some elements which are having credit entry. Let's look at some elements which are having credit entry. So credit entry items, we can look at issues like liabilities. All liabilities are having a credit entry. So that's the first thing. All liabilities are having a credit entry. Then we look at the second item. We can talk about provisions. Provisions are having credit entry. We can talk about gains are having credit entry. Revenue having credit entry. We can talk about income, the same as revenue, though notwithstanding. We can talk about issues of, let's say, let me add point 4, let me add issues of drawings to that. Then in the last perspective over here, I'll talk about equity, into brackets, capital. We are saying that these items are having what? Credit entries. So these are the 5 items which are having credit entries. These are the 4 items which are having debit entries. The golden rule in accounting is that an item which is having a debit entry is going to increase by debiting it, and it will decrease by what? Crediting it. So there's a golden rule. There's a golden rule. Golden rule states that item having a debit balance will increase by debiting it and will decrease by crediting it. Good. Let's use an example. If I have, let's say, an account receivable, which is a current asset. So let's say at the beginning of 2020, the account receivable balance was, let's say, $2,000. If it happens that there's an additional account receivable for the period, because account receivable is an asset and all assets are having debit balance, if there's an additional account receivable, I will debit the account receivable account by that value. If it happens that any of them pay their money, I'm supposed to call that shortfall, cause the shortfall by crediting the account receivable balance by that value. And the same principle holds in the case of items which are having credit balances. Items which are having credit balances will increase by crediting it, and it will reduce by debiting it. So if you go for a loan of, let's say, $50,000, and there's an additional loan that you have acquired, because a loan is having a credit entry, we are going to top up by crediting the loan account with the addition. But if it ends out that you're able to pay part of the loan, then you are supposed to debit the loan account with the amount that you have paid. So for short, an item in the case of an asset is having a debit balance. It increases by debiting, it reduces by what? Crediting. In the case of credit entries, just like provisions or revenue, revenue is having a credit entry, it increases by crediting, it reduces by what? Debiting. The first standard that I'm looking at, as I've already hinted, every accounting standard is having 3 main elements. We have the recognition aspect of the standard, we have the measurement aspect of the standard, we have the accounting treatment, that is the debit and credit. Right. So the first standard is IAS 2. But before we look at IAS 2, we have the first standard in accounting, which is IAS 1, which talks about presentation of financial statement. And this standard really shows us, accountants, the layout, how financial statements are supposed to be prepared. Though notwithstanding, financial statements of every entity will not be the same. But the rationale behind what the IASB, the International Accounting Standard Board, came out with regards to how financial statements should be presented, should still be in line. Just in the case of, let's say, maybe a manufacturing organization. A manufacturing organization will earn revenue by selling its output. But in the case of a bank tends out to get revenue through, let's say, interest income. So that perspective. So it is not going to be the same revenue for a bank. It's not going to be the same as revenue for, let's say, a manufacturing organization, or better still, let's say, a school in that sense. So inventories. We are saying that inventories should be carried at the lower of cost and the net realizable value. So this aspect of the standard shows us how to measure inventory, how to give quantification of inventory. So if you go into the state of financial position, how do you determine the value of your inventory? The value of your inventory can be either the lower of the cost or the net realizable value. So I have to compare the cost of the inventory to the net realizable value. The lower of these two will be the value of the inventory to be recognized into the books of what accounts. But we are saying that the cost can come from two main perspectives, either by buying the inventory or by making the inventory ourselves. If we turn out to buy the inventory, then the cost of the inventory is going to be the purchase cost. The cost of the inventory is going to be the purchase cost or the purchase price, plus any other cost which will bring this inventory into its workable condition and location. Probably, if you do not incur cost of, let's say, transportation, you cannot really get your inventory at your premises to be converted into an output. So such a cost is really important. It's really a specific cost, or it is really a relevant cost, and it's supposed to be capitalized also as part of the cost of the inventory, right? So we are saying that trade discounts are deducted. Trade discounts are deducted, but cash or settlement discounts are not. So if you tend out to get a discount, the discount means a reduction, and that discount is taken off the value of the inventory. There can also be an instance where the inventory is going to be manufactured or is going to be made. In that case, by manufacturing that raw material, there's going to be, let's say, material cost to still get the inventory into being. And we can record that as seen over here. The labor cost, you are supposed to get the services of labor before you can get your material. So in that case, which is the same as your inventory, we can also record the cost, that inventory that is going to come from labor, right? Then lastly, if there exists an overhead, here we are not talking about any other overhead, administrative overhead. We are talking about a specific overhead, which is a relevant cost. So again, if we are making, we are supposed to look at all costs, which is really relevant. Then we are going to capitalize such cost as the cost of the inventory. But students have to note that abnormal cost or abnormal loss is not going to be capitalized. A normal loss in regard of probably coming out with the inventory is going to be capitalized. So students have to know the difference between abnormal loss and the normal loss. Normal loss will be capitalized as part of the cost of the inventory. Instead, abnormal loss will be expense. If we are talking about storage cost can either be capitalized or be expensed. What instant do we capitalize storage cost? If the storage cost is coming based on the raw material, then we are going to capitalize. But a storage cost in relation to a finished product will not be capitalized, instead be expensed. So students are to note that. Let me highlight the storage cost in red. Let me highlight it in red. We are saying that we don't have a strict jacket. It depends on the situation. If the storage cost relates to raw materials, then we will capitalize it as part of the cost of the inventory. But if it happens that the storage cost relates to a finished product or a finished good, then that storage cost is supposed to be expense. Abnormal loss is supposed to be expense, and normal loss is supposed to be capitalized as part of the cost of the inventory. Administrative costs and selling expenses are not capitalized as part of the cost of the inventory. Instead, it is treated as an expense. So we have seen possible ways of determining the cost of an inventory. We have seen possible ways of determining the cost of an inventory. We are going to determine how the net realizable value can feature as we hinted, in determining the measurement aspect of IAS2 is either the lower of cost of the inventory or the net realizable value. So I just have to identify the cost of the inventory and the net realizable value of the inventory. The lower of these two will be denoted as the value or the cost of my inventory. So how do you determine the net realizable value? The realizable value is just the market value. The value if I decide to say to sell this product. So the amount at which inventories are expected to realize should be based on the most reliable evidence available at the time of the estimate, less any cost which directly relates to it. So we are talking about net. That means that there's going to be the gross realizable value less any other expenses or costs that we are going to incur to sell the inventory, right? So this is how to do that. This is how to go by that. Now let's talk about, we have talked about the measurement aspect of IAS2. As you can see, we have not talked about the recognition. Inventory is what? A current asset, and it is an asset. So we tend to debit our state of financial position by that. But there are instances where some companies will first of all treat it as a cost of sales and later on passes through what? An expense. So it depends on what the entity is actually looking at. But in the general sense, we are supposed to treat inventory as what? An asset into the statement of financial position. Another good standard that students are to note is in relation to IAS 23, borrowing cost. I'm picking all the standard. I'll make sure I go through all the standard so that at least you'll be fine. But I'm just picking up one after the other, then digest it, right, in that sense. So IAS 23 is borrowing cost. This is when we decide to capitalize interest. When we talk about borrowing cost, this is a cost which comes with borrowing as a result of going to obtain a loan or secure a loan from a bank. The bank is saying that because you decided to come for my money as a loan, then it is going to create cost for you. What is the cost? The cost which comes here is the interest payment. Because if I came for 15,000 Ghana cedi or $15,000, at the end of the day, I still give you back the $15,000. But whatever I'll pay as extra, it's just like a punishment to me. It's creating cost for me. If I decided not to come for your loan, I wouldn't have paid this what interest. It is also going to be a return to the person who gave you what the loan. You will see it as a cost by paying interest. The person who gave you the loan will see it as a return. In fact, that's the economic sense by giving somebody a loan in that sense. So by giving you a loan, you are going to pay interest to me. The interest, you will see it as a cost, but I will see the interest as a return for having given you my money as a form of what loan. So borrowing cost per the IAS 23 standard only comes in when an organization goes for loan to self-construct an asset. If we go for loan, irrespective of whether we go for the loan, if we go for loan, we use the loan to self-construct an asset, then borrowing cost in terms of the IAS 23 standard comes in for accountants and auditors to consider, right? So the main metric here is that they've gone for loan and they're using the loan to self-construct an asset. If they go for loan and they do not use it to self-construct an asset, we will not talk about IAS 23 in that regard. So interest on borrowing to self-construct an asset should be capitalized. So we are only going to capitalize the interest cost as part of the value of the property. But here, at what extent do we have to capitalize that? Is that at the point where you got the loan? The IAS 23 standard is really going to explain that. Right. Now, we will start capitalizing the interest at the point where we start capitalizing the interest at the point where we have started using the loan to self-construct the assets. What am I saying over here? Let me give an example. Let's say that our company went for the loan on 1st January. Let's say went for the loan 1st January 2020. We went for the loan 1st January 2020, but we never used the loan to self-construct an asset. We started using the loan to self-construct the asset from 1st May 2020. So you are saying that if we started using the loan to self-construct the asset on 1st May 2020, then that is where the capitalization of the interest cost has to begin. We cannot capitalize it, capitalize the interest from 1st January. Though that is the point where you went for your cash, let's say $50,000. That is the point where you went for the loan. I was able to secure the loan from 1st January 2020, but I didn't use the loan to self-construct the assets from 1st January. So from January up to April ending, I cannot capitalize that interest. Though you pay that interest, which is supposed to be seen in your P&L account, but the capitalization aspect of the interest should start from 1st May 2020 up to the reporting period in that sense. Now, there's a very beautiful thing over here. If you capitalize that interest, then we can also depreciate that interest that you have capitalized. Because if I capitalize that interest, I will tend to say that that value will be added to the total value of the property, plant, and equipment. At the point where I'm calculating depreciation, I can calculate the depreciation to add up to the interest. That means that the portion of the interest which was capitalized will also be depreciated. So capitalization, so what impacts, we are looking at what impact will it have on depreciation. If you capitalize the interest, we are saying that what impact will the capital, that is the interest that you have capitalized, have on depreciation. We are saying that we can also calculate depreciation in that light. Capitalization of borrowing costs shall be suspended during extended periods in which active development is interrupted. So as a result of you capitalizing it, when there's an extended period of suspension of the construction of the asset, then we are supposed to cease capitalization. Capitalization shall cease when construction or development is complete. So at the point where you have completed the construction of the asset, then you need not to no longer capitalize that interest cost. So I can highlight that in yellow. These are the conditions. The examiner brings in dates to get the student confused. Now let's look at more details pertaining to IAS 23 borrowing costs. Circumstances when and an amount at which borrowing costs should be capitalized. So we are looking at instances when we are supposed to capitalize borrowing costs and instances where we can determine the valuation of a borrowing cost. So let's look at the first point. Borrowing costs directly incurred on a tangible or intangible asset that takes a substantial period of time to get ready for its intended use or eventual sale, such as a qualifying asset, must be capitalized as part of the cost of the asset. So this is the first condition which we have gone through. Let's look at the second condition. Borrowing costs are based on the effective interest rate, including amortization of discounts, premiums, etc. will be covered in later chapter, which is financial instrument. We will look at financial instrument IFRS 9 later on specifically borrowed funds or on the weighted average of the cost of the pools. Here we are going to look at some examples. I'll solve questions with you pertaining to this standard. There will be an instance where we went for, let's say, multiple loans, but the examiner will tell you that you actually use part of the loan. He will not tell you where you are actually taking that money from. In that case, the specific interest rate to use, which is the effective interest rate, will be the weighted average cost of capital. Because we are actually coming out with the funds to be used in the self-construction from a pool of funds, we cannot just use one specific interest rate. Hence, we will calculate the weighted average cost of capital, and the WACC will turn out to give us the interest rate, which we are going to use as the effective interest rate. So just note that. And that is point 2 as highlighted. We come to point 3, very, very important issue here. Capitalization should commence when expenditure is being incurred on the asset, as I explained. We start capitalizing the interest when the capitalization or when we actually use the loan to self-construct the asset, not when you went for the loan. So as I've hinted, if I decided to go for a loan on 1st January 2020, but I started using the loan to self-construct the asset from 1st May, capitalization cannot start from 1st January. It will instead start from 1st May. Next important point, interest earned from a temporary investment of specific loan should be deducted from the borrowing cost being capitalized, except during periods of suspension. this side is really of importance for the financial reporting students now. Where the examiner previously has been examining point 1 to point 4, but now he has actually been looking at issues of what the next point which have been highlighted. There can be an instance, just look at the example I gave. I went for the loan 1st May 2020, but I never started using the loan to self-construct an asset. So from the period 1st January 2020 to 1st May, I can decide to, though it's a loan I've gone for, I can decide to invest the loan somewhere. Now we are saying that when you invest the loan somewhere, the interest revenue or income that you will get from investing that loan, when you calculate the overall borrowing cost, you are to deduct that interest income from the borrowing cost, and whatever will be left will be the overall borrowing cost to be capitalized. So it is an important side of the standard that every student now, it is an important side of the standard that every student now trying to write financial reporting should look at, right? Next issue, if not eligible for capitalization, borrowing costs must be expensed. So we are saying that if we go for the loan and we don't use the loan to self-construct an asset, that is when it is not eligible for capitalization. And hence the interest on the loan is supposed to be expensed. Borrowing costs cannot be capitalized for assets measured at fair value. Very important thing to also look at. The conceptual framework defines an asset. If you go through all the accounting standards, we have just 2 areas where we define what an asset is. The first definition of an asset came under IAS 1, presentation of financial statements, where we define an asset as an economic resource. Then lastly, where we have the definition of an asset is IAS 16, property, plant, equipment, where we also define an asset as an economic resource. So the conceptual framework defines an asset as a resource controlled by an entity as a result of past transactions or events from which future economic benefits, normally in terms of cash flow, are expected to flow to the entity. In the case of an asset, it's a resource, and every resource will create what benefit to the entity. Financial position, however, assets can only be recognized on the statement of financial position when those expected benefits are both probable and can be measured reliably. The framework recognizes that there's a close relationship between incurring expenditure and generating assets, but they do not necessarily coincide. The examiner says that development expenditure, perhaps more than any other form of expenditure, is a classic example of the relationship between expenditure and creating an asset. We will look at the difference between revenue expenditure and capital expenditure. For capital expenditure, we are all the time capitalized. In the case of a revenue expenditure, which is recurring, it is all the time treated as an expense. So I've gone through, for some time now, I've gone through IAS 2, which is inventory recognition. Then I've gone through IAS 23, which is borrowing cost. The next standard to look at is in the area of investment property. Now, let me give a strong hint over here before we move. We have IAS 16, which is property, plant, and equipment. So property, plant, and equipment. Though we've not gotten to IAS 16, but let me explain. Per the standard, IAS 16 PPE is used for administrative purpose. It's used for administrative purpose. That is the vision and mission of the company. If we exist as a school and we have, let's say, a car, that car will be called a PPE, because we are using that car for running the operations of the school. In that case, we are using it for the mission and vision of the school. But if it happens that we are using the property for commercial purpose, but it's not the mission and vision of the school, then we will call that property investment property. And that investment property is what we call IAS 40. That is the next standard to look at. So investment property. There can also be an instance where, so that is for commercial purpose. There can also be an instance where a property which is already added to the PPE can now be held for sale. Already it was part of IAS 16. So in the state of financial position on current assets, you see property, plant, equipment. That value is part of the total value of the property, plant, equipment. But if management decides that they are going to hold it for sale, then from that day, it ceases to be recognized as IAS 16. Instead, we are going to give it the name IFRS 5, which is asset held for sale. Asset held for sale and discontinued operation. And discontinued operations. So students are to note that the overall categorization of PPE. So if you have, let's say, under the non-current assets side, NCA, let me just make it NCA here. If I'm having a total value of PPE, let's say PPE. PP is, say, let's say PP is 50,000. I'm just giving an illustration. Let's say I have $50,000. And it happens that 2,000 out of this 50,000 now is related to an asset. And I'm saying that I do not want to use this asset any longer for administrative purpose. That is the mission and vision of the business. I want to what? Rent out what? This property. Use it for what? Rental or for commercial purpose. Then from that day, I cannot recognize this 2,000 as a PPE any longer. Instead, just beneath the non-current asset, I am going to give that 2,000 the name, which is going to be investment property. Then in that regard, we will not have the PPE to be 50,000. It will change from 50,000 to 48,000. That means that part of it, which is the 2,000, is no longer used for administrative purpose. So do not add the 2,000 to it. So we are supposed to separate, give it a separate line of item on the face of the statement of financial position. So I will come here and give it the name investment property. It is still what? A property. So investment property, right? Sometimes some banks are having properties in that nature. But the changes in fair value of this investment property will be recognized later on, and we will look at it when we tend to look at. There can also be an instance where, say, 10,000 out of the 48,000 has now been declared as held for sale. So if you remember, the total value was 50,000. 2,000 now became investment property. And we are supposed to take it out of the PP value. We are saying that 10,000 out of the 48,000 now, in subsequent period, by management is going to be held for sale. Right? So if it is held for sale, then we are supposed to take that 10,000 also out of the 48,000 and give it a separate name, asset held for sale. Asset held for sale. This is mostly notable in the case of what banks. So if I make it 10,000, then this figure should change from what? 48,000 to 38,000. So by adding up, you realize that the 38,000 plus 2,000 plus 10,000 will still give 50,000. Earlier on, because we're using the entire 50,000 for administrative purpose, we gave it the name PPE. But later on, we realized that 2,000 was used for commercial purpose, and because it was used for commercial purpose, we gave it the name investment property. And lastly, we decided to hold part of it for sale, and that relates to IFRS 5. So if you decide to recognize this in the earlier period total value of PPE, you should know that some element of it can now flow to IAS 40, which is investment property, or can flow to asset held for sale. So let's look at IAS 40 in detail. Investment property. This is another easy standard, often examined as part of a larger published account or final account question, and recently was a part of the statement of cash flows. In June 2013, as if to check if students were studying the whole syllabus, there were 10 marks on this standard, right? So it is very, very important for students to note. What is an investment property? Let me highlight that in yellow. What is an investment property? An investment property is land or buildings or part thereof held by the owner to generate rental income or for capital appreciation or both, rather than for production or administrative use. So we said that it is not held for administrative purpose. If a property is held for administrative purpose, that relates to IAS 16, which is property, plant, and equipment. But for investment property, that property is just a normal property, but it is held for rental. So if you have land and you are not using the land for why you exist as a business, and you are using it for rental, right? Probably maybe some people can just come rent the land for whatever they want to use it for. You cannot add that land to your PP or IAS 16 on the face of the financial statement. Instead, you treat it as a separate line of item in the statement of financial position as an investment property. Right? Good. Let's proceed. Why the standard is required? What do you think the need for this standard? Rather than investing their surplus cash in stock and shares, a company may choose to invest in bricks and mortar, that is land and building. Stock and shares would not normally be depreciated. So why do we have to represent this? Therefore, there is exemption available from depreciation. They are exempted. If we have stocks, shares, we cannot depreciate what? Shares. We can look at the valuation or the measurement aspect of our investment property, either a fair value model or a cost model. So we can use the fair value model, we can use what? Also the cost model. If we use the fair value model, then the changes in the fair value is supposed to be recognized in the P&L account. What are we saying over here? At the beginning of the year, the fair value of the investment property was, let's say, $2,000. At the end of the year, it has changed to $3,000. The difference, which is 1,000, is supposed to be recognized in the statement of profit and loss account as what? A gain. So that is what we are talking about. Then, if we're using a cost model, just in the case of what? IAS 16. A cost model, how do you calculate the cost of a property? Let me just indicate that here. The cost of a property is going to be, that is the overall cost. We can use what you call the carrying value. Carrying value. Carrying value is also called the net book value. So you can use that net book value perspective to determine the valuation of cost of a property. That is going to be the cost less depreciation, less impairments. Less depreciation, less impairment. And this will give you the total carrying value. This will give you the total value. Let me represent it to what? Green. So we can also use the same cost model, just like what we do in the case of what? IAS 16. IAS 16, right? Next standard, IAS 38, that is intangible assets. IAS 38, that is intangible assets. After going through IAS 38, I'll look at the next standard, then probably we can give it a bash. Right, so IAS 38 is intangible asset. These assets are also recognized on the face of the financial position as part of the non-current assets. They are assets. These assets are intangible. Note for sure that goodwill, in the case of what? A property, plant, equipment, IAS 16, we depreciate properties. We only have exemption. Land, we do not depreciate land. So whatever value of land that we have is still going to be the same, but instead land will appreciate. So for the case of land, we do not depreciate land. In the case of PP, which is IAS 16, it can reduce in value by depreciation. In the case of an intangible asset, it reduces in value by amortization. So we can amortize an intangible, then we can depreciate a property, plant, and equipment, right? But in the case of goodwill and other intangible assets, which do not have a limit in terms of lifespan, just to say, an intangible asset which is into perpetuity, we do not amortize such intangible asset. So the conceptual framework defines an asset as a resource controlled by an entity as a result of past transactional event from which future economic benefits, normally net cash inflows, are expected to flow to the entity. Right. The framework recognizes that there's a close relationship between incurring expenditure and generating assets, but they do not necessarily coincide. The examiner says that Development expenditure, perhaps more than any other form of expenditure, is a classic example of the relationship between expenditure and creating an asset. How much do you think companies like JSK spend on research and development each year? There can be an instance where we can decide to sit down to look at how much cost we incur on research and development in that regard. Research cost all the time expense, development expense, and development cost all the time what capitalized. Did you know that the treatment of development expenditure in IAS 38 is an exception to the basic rule that where prudence and accruals are in conflict? Are we aware of that? In instances where we have what? Development cost. The development cost, we are supposed to determine the total value of development cost. Then the total value which comes with the development cost is supposed to be what? Capitalized. Research cost. Research is original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. We tend to incur research costs if we are coming out with maybe a technological asset. In that case, we come out with the research, and the research creates cost. Are we supposed to capitalize the research cost? We are saying that we treat it as an expense. There can also be a development expenditure, which we are going to capitalize. Treatment. Development expenditure must be carried forward if special criteria are fulfilled. That is, before we say that we are capitalizing, it should meet the development cost, should meet the criteria. Up until this criteria is fulfilled, development must be written off to the statement of profit and loss account. So we have a specific criteria that is supposed to meet. If it doesn't meet it, then we can treat a development what cost us an expenditure. If it meets it, then we can capitalize it. But once the development phase is completed and criteria fulfilled, amortization begins. That means that if it should meet the criteria, then we turns out to capitalize it. Then we cannot depreciate intangible asset. Instead, we can now begin amortization of intangible asset. It holds amortization of intangible asset holds just like how we deal with depreciation. So look at the number of period that we have for the intangible asset. Then we use that in our amortization, right? Brands and other intangibles. Internally generated brands, must hits, publishing titles, customer lists, and items similar in substance shall not be recognized as intangible assets. They cannot be distinguished from the cost of developing the business as a whole. So this is an important issue pertaining to the standard to look at. Let me make that red. Why a standard is required? Why do you think that it's important for us to go through IAS 38? Non-current assets and goodwill are recorded in the financial statement at not more than their recoverable amount. Any resulting impairment loss is measured and recognized on a consistent basis. So in determining the value of an intangible, it can also be purchased. If it is purchased, then we need the total cost, another cost which will make it relevant. And we are saying that in the case of a research cost, it's all the time expensed by IFRS, but in the case of development cost, it can be expensed or can be capitalized. We will capitalize it if only the cost meets the criteria spelled out by the IAS 38. The next standard to look at is in the case of IAS 16. Let me bring in the next standard, which is IAS 16. IAS 16, that is property, plant, and equipment. That is IAS 16. We are saying that with IAS 16, we use this property for administrative purpose. That is the reason why we exist, the mission and vision of the company. There was a time where a colleague of mine working with a hotel, was confused as to how to determine the recognition of 5 of their rooms, which they actually rented out to some people to be used for seminars in terms of 5 months perspective. Though they exist as a hotel, and their main reason for existing, why they exist, their mission and vision is to what? Rent out their rooms for people to sleep in and do whatever they want to do, right? So if we are using the rooms for why the hotel exists, that is supposed to be in relation to still I-16. But my friend was confused. Probably he has gone through the standard that if a property is used for rental, it's supposed to be recognized as investment property. But that is what? No, because we are using the property for the mission and vision of the company. So if we are using the property for how or why the company exists, then that property should be used for what? Or should be recognized as what I-60 property, plant, equipment. But at the instance where they rented out part of their rooms for some people who are coming there to embark on seminars, we are not using it for why we exist. Why we exist is that we rent it out for people to sleep in. But the instance where people come in morning to evening, they have their seminars, they go to their various homes, they do not sleep in there. But that is not the mission and vision of the business. Though it is for rental, the mere fact that it's being rented does not mean that we are going to treat it as I-16. So students are to note that sort of a complex issue. So I-16 property, plant, equipment, we can determine the cost, initial measurement. Initially, IS in terms of PP can be recognized at what? Cost. We can measure it at cost. And the cost model is just like what we have determined. We can decide to buy the property. We can decide to make the property. If we are buying the property, then all costs in terms of the purchase price plus any cost which will bring this asset into a workable condition location is supposed to be capitalized. Perfect examples can be in relation to, let's say, installation costs. So if I buy it, then the purchase cost plus, say, shipping costs. Shipping costs will also be capitalized. Let's say installation costs. Just giving some examples. Installation costs, maybe cost of removal or dismantling. This is also a relevant cost, or cost of decommissioning. All these costs will be what? Capitalized as the total cost of the product. So in that regard, I will just sum the items which comes up. But we are saying that the cost of training employees will not be capitalized as part of the cost of the property. So in that regard, we cannot capitalize the cost of training employees. So let's note that. That will be the total cost. Before you think of depreciating it as a result of usage. Before you think of depreciating it as a result of usage. Good. So this is when you decide to purchase it. This cost is coming when it is purchased. So when it is purchased. But when it is made, then just like above, when it is made, just like above, there's going to be direct material cost. If it is made just like above, there's going to be direct material cost in making the property, direct labor cost incurred in making the property, overhead cost. Here we are looking at the specific overhead, not the general or the administrative overhead. Any general or administrative overhead is going to be expensed in that sense. So the same technique or the same principle holds in the case of IAS16. With IAS16, we say initially it is measured at cost, but subsequent measurement, we can either use cost or we can use what you call revaluation. Now, there's one beautiful thing that students are to note. If we are using, you can decide to start with cost initially and subsequently still cost. Just like in the case of the US, where CPA perspective, measurement of the cost of a property is cost throughout, initial cost, subsequent cost. But in the case of IFRS, the European perspective, or in the case of Ghana, we can use maybe revaluation in the subsequent measurement. If we're using the revaluation method, then students are to be very careful with such issues. At the point where there's going to be the revaluation, we are supposed to determine the net book value of the property. At that point where there's going to be the revaluation. Then the revalued amount is what we are going to use subsequently in the calculation of depreciation. The cost value will cease to exist, will cease to be useful. We will rather use the revalued amount subsequently in our calculations. So that is the only thing that students are to note over here. I've hinted that cost of training is not what capitalized. Instead, it is going to be expense. After going through IAS 38, which is intangible assets, and going through issues of IAS 16, which is property, plant, and equipment, it is really, really important for us to look at impairment of assets. And impairment of assets comes with the standard IAS 36. So IAS 36 looks at impairment of an asset. So let's look at impairment of an asset. An asset is going to be impaired. An asset is going to be impaired if we look at two main items. It's either going to be probably the carrying amount, or we look at the recoverable amount. So the comparison of the carrying amount and the comparison of the carrying amount and the recoverable amount will give us the value to be recognized as an impairment value. Right. Good. What do you mean by impairment? If your book value turns out to exceed the value of the property, which it turns out to be in the market, then we say that your asset has been paid. We are not going to be happy as accountants if, in the case of our book, just value in our book value, just the value of your property in your book, if it is having a huge value, but meanwhile, if we take it to the market, it doesn't weigh anything, then we say that your property has been paid. But in instances where I have recognized in my books to be, let's say, 5,000 Ghana cedi, but I get to the market, the value of my property is 18,000. 5,000 has moved to 18,000. In fact, what is important is the market value. So if the market value exceeds the book value, then we can say that there hasn't been any impairment. But the standard says that annually, whether there has been impairment or no impairment, accountant test for impairment, auditor check for what impairment, right? So a reduction in the recoverable amounts of a non-current asset or goodwill below its current amount. In the case of goodwill, we said that when we were looking at IAS 38 intangible asset, we said goodwill, we do not what amortize goodwill, but we can what test for impairment of goodwill, and goodwill is supposed to be impaired. We test annually for impairment. Just like in the case of other intangible assets, as I hinted, if it is having what indefinite lifespan, we do not what amortize it, but we can still what test for impairment, right? Indications of impairment: certain conditions will exist, and when they exist, it triggers impairment testing, right? A review for impairment of non-current assets or goodwill should be carried out if events or changes in circumstances indicate that the carrying amount of the non-current asset or goodwill may not be recoverable. Instances such as a current period operating loss or net cash outflow from operating activities. When you have an asset and there's a current operating loss pertaining to the asset, then it gives an indication of what impairment testing. Next one, a decline. Let me highlight that. A decline in the market value of a non-current asset during the period. So if the market value of the property falls, then we can say that what there's a sign of what impairment of the asset. Evidence has emerged. If evidence has emerged of obsolescence or damage of a property, we can test for impairment. So if a PP is damaged or maybe issues of obsolescence, then we can what say that there are signs of what impairment testing. There has been a significant adverse, here the word is what? Adverse. There has been a significant adverse change in the commercial environment in which the entity operates. We can also test for impairment. A commitment by management to undergo a significant reorganization is also a sign of what? Impairment test, or liquidation, a sign of impairment testing. A major loss of key employees, also a sign of what? Impairment what? Testing. An increase in market rates of interest used to discount future cash flows to their present value. Here, if you have not gone through financial management, you will not get it. We are saying that if your discount factor turns out to be huge, in financial management, you learn that an increase in the discount factor, we are saying that the discount factor or the weighted average cost of capital is having a negative relationship with the market value of a company. So if your discount factor or your WACC increases, the value of a company falls. As the WACC increases, the market value of the company falls. So if I have a cash flow pertaining to an asset and I'm using a higher discount factor, then the value of the property will now go to fall. And if it falls, we say that it will create a sign of what impairment testing, right? So we have given some indicators or some criteria that will trigger impairment testing, and students are to know these issues. When asked, at least you put them down on the face of the paper on your screen, if it happens to be a computer-based exam in your era. Recognition and measurement of impairment losses. Recognition and measurement of impairment losses. Now, if we are testing for impairment, it should affect the overall asset class, right? The impairment review should comprise a comparison of the carried amount of the non-current assets or the goodwill with its recoverable amounts. So, which is the higher of the net selling price and the value in use. So, let me just create an instance over here. So, by measuring, so if I want to measure or determine quantification, so quantification, if I want to record on the state of financial position value, or let's say on the state of financial statement, the value, when impairment testing will affect your P&L also, right? And the part will reduce the value of the property in your state of financial position. So if I want to measure that, then the standard is saying that I'm supposed to look at a comparison between the carrying amounts. So carrying amount, what is the carrying amount? As I have explained, the carrying amount is the same as the net book value. And how do you calculate the net book value? It is the cost less depreciation. Then I'll compare that with the recoverable amounts. Recoverable amounts. The recoverable amounts, we look at two main things. The recoverable amount, we look at the higher of two main things. Let me make that A. So the higher of two main items. What are they? First of all, A. First of all, A, we are talking about the value in use. Then we talk about B. That is the fair value less cost to sell. Fair value less cost to sell. Right. So the comparison of these two. So let's say that the value in use is 3,000. I'm just giving an example. The value in use is 3,000. The fair value is, let's say, 3,800. Then the higher of these two per the standard will represent the recoverable amount. Then the higher of these two, 3,000 will lead to value use, 3,800 will lead to fair value less cost to sell, and what will represent the recoverable amount is the higher of these two. And the higher of these two is 3,800. So hence, I'll put the 3,800 here, which is the recoverable amount. If it happens that the current amount is, say, 4,000, then we say that there has been an impairment. For the asset to be impaired, for an asset to be impaired, the carrying amount, let me make it C, should be greater than the recoverable amount. Let me make the recoverable amount what? RA, right? So we are saying that for us to say that there has been impairment, when the current amount exceeds the recoverable amount, then there has been impairment. So here, let's compare, let's check out the current amount. The current amount is 4,000 here, and the recoverable amount is 3,800. We can see that the current amount exceeds the recoverable amount by 2,000, and the impaired amount is 2,000. So here, there has been payment. There has been an impairment. There has been impairment of, let's say, let me just use dollars. There has been an impairment, or let's say Ghana Cedi, right? There has been an impairment of 2,000 Ghana Cedi, right? Good. Why are we saying there's an impairment? Let's look at it. Let's understand it practically. When you go to the markets, in terms of cash outflow, they are saying that in the market, the value of your phone is 3,800. When you get to the market, it weighs 3,800. Meanwhile, in your books, it weighs 4,000. What is significant over here is not your book value. What is significant here is how your asset will fail in the market. If in the market is doing well, then we say that that is a good thing. But if it's just a book value, the value of this asset in the book, if it is higher than the market value, that is not what relevant, right? So in that case, we say that there has been an impairment. So this is how to determine the recoverable amounts. That has already been explained above. So that is how to determine that. The value in use, I've seen questions where the examiner brings in cash flows for, let's say, year 1 to year 4, just like what we do in financial management. Then he'll give you the cost of capital to discount it to determine the value in the present value sense. Because in determining the recoverable amount, we compare two main things: the fair value less cost to sell. The fair value cost to sell is a value today, but the value in use, he can give you, let's say, values in year 4 and year 5, which you have not gotten there. You are looking at the value, recognizing the value today. So we need the value in use to be a value today. We need the fair value less cost to sell to also be a value today. So far as the current amount is a value today, everything should be today, 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 today. But in that case, you realize that the value in use, he can give you year 3, year 5, year 6. You are not supposed to compare values in a different terrain. At least that would be a wrong comparison. So what you do is that you discount all those cash flows from all those years to their current value, which is today value. And a present value is the value of a property today. So you compare the value in use, which is today, to the fair value less cost to sell, which is today. The higher of the two will be the recoverable amount, which is today. Then you compare the current amount. You calculate the current amount today and compare. So the current amount will be the value today. The recoverable amount will be a value today. Then we look at the difference. The difference will be the impaired amount as at the date of the impairment testing. But there's an important thing for us to consider over here in the case of the cash generating unit. Issues of the discounting that I've talked about, you can read this side, you get those information. Cash generating unit. Impairment testing recognize that if we have a class of assets, we are supposed to carry out an impairment testing for all the class of assets, not just a section. What is a cash generating unit? It is the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or group of assets. So in that regard, there can be a discount factor, which is a discount rate, which we can use to determine the present values of the cash generating unit. If it happens that the cash flows are in future terms, then we need the discount rate, which the discount rate can be the WACC, which is the weighted average cost of capital. We can use it to discount them into present value. And this is how we can calculate present value. So present value can be calculated as the cash flow divided by 1 plus that is the rate. And depending on the number of years, we can input the number of years as power in here. Let's say 2. We can do this, use this as a means of converting a future cash flow or future value to a present value. We can use this. Let me highlight this in that form, right? So there can be an instance where there's going to be reversal of impairment. So there are instances where you can come out with a reversal of impairment according to IAS 36. The reversal of past impairment loss should be recognized when the recoverable amount of the assets, except for goodwill and intangible assets, has increased because of a change in economic conditions or in the expected use of the assets. Increases in the recoverable amount of goodwill and intangible assets should be recognized only when an external event caused the recognition of the impairment loss in previous periods, and subsequent events clearly reverse the effects of that event in a way that was not foreseen in the original impairment calculation. So we say that there are instances where there can be a reverse of impairment. When you realize that whatever condition which contributed to the impairment, there has been a favorable condition to that, then we are supposed to reverse that impairment test, right? NB, IAS 36 says that the following order must be used when we are having a cash generating unit. How do you do the impairment? 1, to reduce any specific asset that has lost value. You can reduce any specific asset that has lost value. 2, to reduce the carrying amount of any goodwill allocated to a cash generating unit. A cash generating unit is CGU, cash generating unit. And then, step 3, then to the other assets of the unit pro rata on the basis of the current amount of each asset in the unit, but not to be reduced below the net realizable value. So we said that the first thing to do when you are allocating impairment amount, I will show you with the use of what questions. First of all, it has to relate to a specific asset which has lost its value. Second thing should be goodwill from the cash generating unit. Any other thing left should be the test or the allocation should be made on a pro rata basis, right? Moving from IAS 36, which is impairment testing, we will come to IAS 41, which is agriculture. Agriculture happens to be a very good standard in relation to a biological asset. So let's look at the overview. IAS 41, agriculture, sets out the accounting for agricultural activity, the transformation of biological assets, living plants and animals into agricultural produce. That is a harvested whole product of the entity's biological assets. So in instances where we harvest our product, it can be a plantain, it can be, let's say, sugarcane, whatever. If it is harvested, we should determine the valuation per accounting standard. The standard generally recognizes biological assets to be measured at fair value cost to sell. Really, really important for measurement purposes. So it is measured at fair value less cost to sell. Fair value less cost to sell, right? Key definitions: biological assets. What is a biological asset? We are talking about living animals and plants. They are biological assets. Agricultural produce is also important terminology to also note by students. When you talk about agricultural produce, we are talking about the harvested product from biological assets, which can be a living animal or a plant. Cost to sell. That is incremental cost directly attributable to the disposal of an asset, excluding finance cost. What is a finance cost? A finance cost is interest. When you talk about finance cost, we are talking about interest and income taxes. Initial recognition of IAS 41 agriculture. An entity should recognize a biological asset or agriculture produce only when the entity controls the asset as a result of past events. If in instances where it is probable that future economic benefits will flow to the entity, and the property should be measured reliably. Measurement. Biological assets should be measured on initial recognition and at subsequent reporting date at fair value less estimated cost to sell, unless fair value cannot be measured reliably. So this is really important for measurement purpose. So we said initial measurement and subsequent measurement is at fair value less cost to sell. The gain on initial recognition of biological assets at fair value less cost to sell and changes in fair value less cost to sell of biological assets during a period are reported in the net profit or loss account. That is in the state of P&L account. All costs related to biological assets that are measured at fair value are recognized as expense when incurred, other than cost to purchase biological assets. So cost to purchase a biological asset is different from what we are talking about over here. Any costs which will really make this agriculture, a biological asset, be in a workable condition location, right? Apart from all those items that you have considered, can be treated as an expense. And I can decide to highlight that in, say, green, right? IAS 41 presumes that fair value can be reliably measured for most biological assets. However, that presumption can be rebutted for a biological asset that at the time it is initially recognized in financial statement, does not have a quoted market price in an active market, and for which other methods of reasonably estimating fair value are determined to be clearly inappropriate or unworkable. In such a case, the asset is measured at cost less accumulated depreciation and impairment losses. So we are trying to say that if fair value valuation, we have fair value, we have accounting standard called IFRS 13 in terms of fair valuation. It shows us how to determine fair value of such an asset. But if it is not possible that we can use the fair value method, then the standard is saying, IAS 41 standard is saying that we can measure it at cost less accumulated depreciation and impairment losses, just in the case of property, plant, and equipment. But in that case, the entity must still measure all of its other biological assets at fair value less cost to sell. So this is really an important condition for students to really look at. So we really have to master this. Let's try to master this. Let me use this color. Right, let me use this color. So let's come to IAS 2020, government grants and other government assistance. And other government assistance. Government grants and other government assistance. Government grants and other government assistance. That is in relation to IAS 20. IAS 40 talks about investment property. IAS 20 talks about government grants and other government assistance. Government grants and other government assistance. Government assistance takes many forms, including grants, equity finance, subsidized loans, and advisory assistance. Government grants are made to persuade or assist enterprises to pursue courses of action which are deemed to be socially or economically desirable. So here, the government is providing you with some assistance, but it comes with what? A string attached. And based on your ability to comply with the string, then we can really recognize it as IAS 20, government grants and other government assistance. Treatment of government grant. Treatment of government grant. There are two methods of presentation of grants related to assets acceptable to IAS. One, grant to be set up as deferred income, which is then recognized as income on a systematic and rational basis over the useful life of the asset. Second, deduct the grant from the cost of the asset and depreciate the net cost. You can look at it just like in the case of the UK perspective, right? So we can still recognize a portion in the statement of financial position and the statement of P&L. Government grant creates a revenue and a cash flow, and hence we can also record issues of grants in the statement of cash flows, right? I think this is where we bring our meeting for today to an end. In our subsequent meetings, we will look at the other standards which we have not dealt with. But notwithstanding, I've only walked you through the theoretical aspect of the standard. We will relate the theories that we have learned to solving questions. I think if you go through these and get a good grasp of the theory, it will really help. So this is where we are going to end for today. This is where we are going to end for today.